In the labyrinthine world of finance, where fortunes are made and lost in the blink of an eye, one unlikely player emerged to challenge the status quo and reshape the narrative of modern markets. Enter GameStop, a brick-and-mortar relic in the digital age, once dismissed as a relic of a bygone era. But in early 2021, this humble retailer became the epicenter of a seismic upheaval that sent shockwaves through Wall Street and captured the imagination of the world. Fueling this unprecedented frenzy were legions of retail investors, united by a common cause and armed with nothing more than smartphones and social media accounts. Their rallying cry, to take on the establishment and defy the odds. I saw an opportunity to stand up to the big guys, to show them that Main Street can compete with Wall Street. It wasn't just about making money. It was about sending a message, about leveling the playing field and holding institutions accountable. As GameStop's stock price soared to dizzying heights, institutional short sellers found themselves on the wrong side of a historic showdown. With billions of dollars at stake, they scrambled to contain the fallout, but the tide of retail investor fervor proved unstoppable. In the aftermath of the GameStop saga, questions emerged about market integrity, regulatory oversight, and the future of finance. As lawmakers and regulators grappled with these issues, the world watched with bated breath, eager to understand the lessons learned and the implications for the future. Join us on a journey into the heart of the GameStop phenomenon, where the lines between David and Goliath blur, and the power of the people transcends the confines of Wall Street. This is the story of the GameStop short squeeze, a tale of rebellion, resilience, and redemption. Before starting, don't forget to like and subscribe to our channel for more future updates. Understanding short selling. Short selling, a complex trading strategy, involves investors borrowing shares of a stock from a broker and selling them on the open market with the anticipation of repurchasing them at a lower price in the future. Short sellers profit from the price differential between the sale and repurchase prices. However, short selling exposes investors to substantial risks, including unlimited potential losses if the stock price rises instead of falls. The GameStop short squeeze. GameStop, a brick-and-mortar video game retailer struggling to adapt to the digital era, found itself thrust into the spotlight as a battleground between retail investors and institutional short sellers. GameStop's stock, burdened with a high level of short interest due to doubts about its business model, became a prime target for a short squeeze orchestrated by retail investors congregated on social media platforms. Retail investors, emboldened by their collective strength and fueled by a desire to challenge Wall Street's hegemony, launched a coordinated buying campaign aimed at triggering a short squeeze in GameStop's shares. As retail investors flooded the market with buy orders, GameStop's stock price skyrocketed, catching short sellers off guard and amplifying upward momentum. The rapid appreciation of GameStop's stock price defied conventional market logic, leading to unprecedented volatility and significant losses for institutional short sellers. Market-to-market losses. Market-to-market losses, also known as mark-to-market losses, are a fundamental concept in finance that refers to the revaluation of assets or securities to reflect their current market prices. This process occurs periodically and is crucial for investors to accurately assess the value of their holdings in light of prevailing market conditions. In the context of the GameStop short squeeze, mark-to-market losses played a pivotal role in amplifying the financial turmoil experienced by short sellers. As GameStop's share price defied all expectations and soared to unprecedented heights, short sellers found themselves facing mounting mark-to-market losses. These losses occurred as the value of the shares they had borrowed and sold short plummeted, forcing them to recalibrate their positions and potentially incur substantial financial liabilities. The surge in GameStop's stock price far surpassed the worst-case scenarios envisioned by institutional investors and hedge funds who had taken short positions in the company. Many of these short sellers had bet on GameStop's decline, believing that its business model was outdated and vulnerable to disruption from digital competitors. However, the coordinated buying campaign orchestrated by retail investors on platforms like Reddit's Wall Street Bets caught him off guard, triggering a short squeeze that exacerbated their losses. Data from financial analytics firms such as Ortex and S3 Partners provided insights into the magnitude of the mark-to-market losses incurred by short sellers during the GameStop frenzy. According to these sources, short sellers collectively suffered approximately $838 million in mark-to-market losses as GameStop's share price skyrocketed. These losses were a direct consequence of the exponential rise in the stock price, which surpassed even the most pessimistic projections, leaving short sellers scrambling to cover their positions and limit their exposure to further losses. The fallout. The GameStop short squeeze sent shockwaves through financial markets, prompting a reckoning within the investment community and igniting debates about market integrity and regulatory oversight. Several prominent hedge funds, notably Melvin Capital Management, suffered significant losses as a result of their short positions in GameStop, with some requiring emergency capital injections to survive. The saga also spurred calls for regulatory intervention and legislative scrutiny, with lawmakers and regulators pledging to investigate the events surrounding the GameStop frenzy and explore reforms to prevent similar episodes in the future. Questions emerged about the role of social media in shaping market sentiment and the need for greater transparency and accountability in financial markets. Conclusion. The GameStop (GME) short squeeze of 2021 stands as a watershed moment in financial history, encapsulating the power of collective action and the inherent risks of short selling. The saga unfolded as a clash between retail investors, united by social media platforms, and institutional short sellers, resulting in unprecedented market volatility and staggering losses. The $838 million in market-to-market losses incurred by short sellers during the GameStop frenzy underscored the unpredictability and complexity of modern markets. As retail investors orchestrated a coordinated buying campaign, GameStop's stock price soared to astronomical heights, defying conventional market wisdom and challenging the status quo. The fallout from the GameStop saga reverberated across financial markets, prompting a reckoning within the investment community and sparking debates about market integrity and regulatory oversight. Several prominent hedge funds, including Melvin Capital Management, suffered significant losses, requiring emergency capital injections to weather the storm. The GameStop short squeeze galvanized lawmakers and regulators to scrutinize market practices and explore reforms to address systemic vulnerabilities. Calls for greater transparency, accountability, and investor protection echoed in congressional hearings and regulatory inquiries, underscoring the need for a more resilient and inclusive financial system. While the immediate fervor surrounding GameStop may have subsided, its enduring legacy serves as a catalyst for change and a testament to the evolving dynamics between retail investors and institutional players. The lessons learned from the GameStop saga will shape conversations about market structure, regulation, and investor activism for years to come. This is it for today's video. What do you think of our video? Comment below with your thoughts and let us know. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.